Okay, I guess we're all here. All the off-island attendees have checked in as well. Good morning, everyone, and welcome to the current expected credit loss session, sponsored today by the Hawaii Credit Union League and CU Pacific Audit Solutions. My name is Grant Kashiwabara, and I'm the Business Services Manager here at the Hawaii Credit Union League. At this time, we'd like to welcome our West Oahu, Kona, Kauai, and Maui attendees. And before we get started, I'd like to go over a couple of items. The first being that today's session is being audio recorded, and a link will be provided via email upon completion. The second is that this will be an unmuted conference, so we encourage people to speak up and make it interactive. We don't want to have our speaker stuck talking for a couple of hours, and we need that interaction, so we're trying to make it a little more lively. So, and the final thing is that if you have a question, you could either ask the question or use the raise hand icon for those who are shy, or chat with the presenter icon as well. So without further ado, I'd like to introduce Denise Yu of CU Pacific Audit Solutions, who will introduce our speaker today. Denise?
Good morning, everyone. Thank you for joining us this early morning. We at CU Pacific are happy to offer this educational session in partnership with Doeren Mayhew on CECL, your new love-to-hate regulations. So thank you for spending your morning digging into the depths of CECL. I know many of you are tuning in, know the faces of CU Pacific. You know them as myself, Denise, as Tracy and Brian. However, many of you are not aware of the relationship and the partnership we have with Doeren Mayhew and Mr. Doug Orth, the partner of Doeren Mayhew. Doeren Mayhew is the second largest audit firm of credit unions in the nation, serving over 350 credit unions in over 40 states. Doug Orth's partner has been a trusted friend and colleague of ours for over 25 years. He's been a valued resource in assisting CU Pacific and our clients with technical, accounting, and regulatory matters over the years. We've partnered with him on several audits. He's here this week working with us to oversee an opinion audit as well as a QSO audit. With the increased challenges facing our credit unions today, with the ongoing compliance pressures, rapid changes in IT, and demanding and complex delivery channels, the value of this partnership allows us to bring industry knowledge to you firsthand, locally, with the support of the Hawaii Credit Union League. Thank you for hosting this. And with the backing of a national firm such as Doeren Mayhew, all while delivering the best values to your members. So now here's Tracy to give you a little more background on Mr. Doug Orth.
Douglas Orth is a shareholder of Doeren Mayhew in the firm's financial institutions group. For more than 30 years, Doug has provided audit and consulting services to credit unions throughout the country. His responsibilities include the planning, coordination, supervision, and review of all financial statements and reports prior to their issuance to ensure professional standards, regulatory requirements, and client expectations are met. Throughout his career, he has supervised and performed in excess of 1,000 audits for federal and state chartered credit unions. As a certified fraud examiner, he has also worked on numerous fraud engagements involving credit unions. This experience has provided Doug with a unique perspective to auditing credit unions and assisting management teams in the development of meaningful internal control recommendations to mitigate fraud risk. A seasoned veteran, Doug is a frequent speaker at national educational industry conferences on a variety of credit union topics. Additionally, he is a member of the firm's annual supervisory committee and board of directors conference committee. And without further ado, I'd like to introduce Doug Orth.
Thank you very much. Aloha, everybody. I've already learned the language from the mainland. Those that can't see, I have a beautiful lay-on this morning. So anyway, very happy to be here. Thanks for the invitation to talk to you some more about CECL. You'll love to hate, a good way to put it, Denise. That by the end of the session, you'll probably be a little glazed over, just kind of like most auditors are that have delved into this a little bit, trying to understand it. It doesn't really take effect for 4 years, so it's out there, and none of us really have, spent a significant amount of time trying to, put it into action. And so we have a theoretic understanding of what it's calling for. I'll go over that and try to give you a little bit more hands-on how you might go about implementing CECL. But as Wendy and the group has already mentioned, keep it interactive if we can. So as much as you have questions, don't hesitate to stop. We'll probably take a break, maybe like an hour in, to kind of at least get more coffee, because you'll find this very lively session. So, caffeine, energy drinks, whatever it might take. Okay, the conversation is about CECL, current expected credit loss. It doesn't just say loan loss, it says credit loss. So credit loss, mainly we're going to talk about loans, but it also touches on credit losses that you might incur for debt securities, available for sale debt securities, bonds, things of that nature, and a couple other, like purchased, acquired assets with deteriorated credit. You typically don't see too much of that in the credit union world. You might see a little bit in connection with an acquisition or a merger, where a handful of the loans that are being acquired really meet that definition because they're seriously delinquent or in foreclosure. But for the most part, you're not going to deal with that. I think over all the years, we've had one very, very large multi-billion dollar client that about 5 years ago, they purchased, I think, about $100 million of deteriorated credit from a bank. And these mortgage loans had already been troubled debt restructured, they'd been refinanced, they've been modified to try to work out a bad situation out in the California market where things were very bad in the 2008 through 11 period. So special accounting rules apply for that, and some of CECL has changed that a little bit. So we're going to try to concentrate more on the loan stuff. Some of the slides have got some commentary on the available for sale debt security or the TDR, and so we'll probably go through those kind of high level, real high level. I don't have this on a slide, but I thought last night in preparing that I might go down a little history with you. I've been working with credit unions since 1980, so 37 years, a long time. Seen a lot in the allowance for loan losses sector, and some of you that have been in the credit union industry a long time might remember some of this. But going back, 40 years ago, how did credit unions charge off uncollectible loans? There was no allowance for loan losses. That was the purpose of regular reserve. So credit unions now, you have undivided earnings and regular reserve as part of your equity accounts. But back in the dark ages, you would charge off your uncollectible loans to regular reserve directly to that equity account. There was no such thing as an allowance account. So right when I started getting involved in credit unions in 1980, it was just on the brink of credit unions starting to adopt generally accepted accounting principles, or GAAP. Prior to that, credit unions were very heavily involved in regulatory accounting practices, or RAP. So what you'd find from the regulator side early on was they looked at delinquency only. So they would look at the establishment of the allowance account, which day one, when that allowance account became part of the financial statement, credit unions got a free transfer from regular reserve to allowance account. So hopefully you guessed right and put enough in there, because the month after, you had to charge the provision for loan loss expense to fund it. So you had that free transfer. No longer did you charge off directly to regular reserve. all went through the allowance for loan losses. Now, how much is adequate? So this is the most subjective account that appears on a credit union's financials, always has and always will be. So the regulators would look at it, and they would pretty much focus on delinquency only. So they would often have a formula as simple as if it's 2 to 6 months, you reserve 25%, 6 to 12, 50, and over 12, 75%. They were done. It was a 5-minute calculation. And then you'd have the auditors come in, and under GAAP, the allowance count had to be adequate to cover the entire portfolio, be it delinquent or not. So you'd have the examiners say, the allowance count needs to be 300,000, and it was. 2 weeks later, you'd have the auditors come in, and they might say it needs to be 500,000. So you had this terrible disconnect between the regulators' view of allowance accounting and CPAs. So, clients, credit unions were really put in the middle because, they want to respect the accounting rules under GAAP, but they also want to respect the regulators, and they don't really want to take more money out of equity to build more allowance count. So finally it all got cleared up, and for many years, we're on the same page, the regulators and auditors, until the financial crisis, come 2008, 9, and so forth. Then all rules were off. The regulators had no respect for GAAP. It was just, how can we get more in the allowance count? And I could probably talk for an hour on all the crazy ways that regulators have found to add more to the allowance account, totally in disrespect to GAAP, but their view, this added more money, that was a good thing, especially in what was termed the sand states. Anybody remember the sand states? That was Florida, it was Nevada, California, and Arizona. Those are the top 4 losers with regard to real estate devaluation. And in those 4 cities or states in particular, the more you can have in the allowance, the better. So we have, many a client, especially California and Florida, where the allowance counts were built to such incredible high levels that, made no sense at all. And history proved they were never necessary. And over the following years, credit unions clawed that back, and for maybe 3-4 years running, they operated with negative provision for loan loss because they had so much that they never needed. They didn't have to fund it any further, just lived off the excess they had, and really presented unreasonable financials because you don't typically operate with a negative provision. So that's the history lesson. That's where we've been. And now, 4 years from now, we're going to current expected credit loss. So, a little background and overview. I've given you a lot of background. Talk a little bit about preparing for implementation, transition rules and guidance in terms of, what do you do day one to make any adjustment to the allowance count from where you are on that prior day. The impact it'll likely have on the allowance account and regulatory capital. Go through some sample methodology calculations and a handful of key takeaways, do's and don'ts. Next, please. All right, so current accounting requires a loss threshold that is both probable and reasonably estimatable. This causes a delay in loss recognition. This is why the Financial Accounting Standards Board, you've heard FASB, they're the rule setters for accounting. So they decided that the financial crisis of 2008, resulted in significant losses appearing that were not adequately reserved for prior to that. And it was a catch-up. So in an effort to try to avoid that situation from ever happening again, the advent of CECL. The next page will show you a little chart, but essentially they felt like the allowance balances were 30 to 60% deficient. So they formed a financial crisis advisory group to look into alternative ways to account for loan losses and other. If you remember back in the day, investment losses and all the corporates that recognize significant investment losses on mortgage-backed securities, that's why this is not just loan loss, but credit loss. The following chart shows you a little bit of a timeline. The line represents the allowance for loan losses balance in connection with the total outstanding loans. When you see in 2008, 9, 10, and 11, the balance of the allowance for loan losses went from below 0.80% of 1%, 80 basis points, all the way up to a little north of 160. So it essentially doubled during the crisis. And all the funding that it took to go from the low end of the chart to the top end, that was all funded by provision for loan losses. So almost every credit union in the U.S. operated with a loss for a couple of years, funding that allowance account. And then you see the tail off where it was overfunded in hindsight, so it came back down to some normal levels through 2016. And so anyway, this is kind of the picture of what FASB was trying to address. And, the advent of CECL is going to try to get that blue line before the financial crisis up about double so that it would be fully funded in the event you had bad news like the financial crisis of 2008, 9, 10. So that's the theory of it. All right? Very, very subjective. So current expected credit loss, better known as CECL, it calculates expected losses over the remaining life of the financial asset, not just loans, but the financial asset. And so you take the amortized cost, subtract whatever allowance for credit losses you come up with, and that's equal to the amount you expect to collect in cash over the duration of that asset. What's different about this model from today is we're currently operating under what's called an incurred loss model. So you only recognize a loss today if you believe the loss has been incurred and you want to measure it up, and then you'll deal with the charge-off usually within the next 3 months, 6 months, a year. So, one kind of, rule of thumb is you should always have today about 1 year's worth of future charge-offs in your allowance account, at least one. Probably 1 to 18 months is a reasonable estimation. But under CECL, you're looking at the life of the loan. So you're not looking at just 1 year or a year and a half worth of coverage in the allowance for what you believe is incurred, but you're looking at the duration of the portfolio. So for a car portfolio, could be 2.5 to 3 years on average. Home equity could be a 5-year, 7-year. First mortgage could be 7 years, 10 years, 15 years. So you have to, consider under CECL, what do we think the long-term losses may shake out, and fund that day one, not when we get there. So that's the big change conceptually. If any of the credit unions in the group have gone through a merger in the last 7, 8 years, the rules for merger accounting have changed a lot from historical. And the way it is currently is under fair value. So when you let's say you've acquired a credit union, a $100 million credit union through a merger, the allowance count of that credit union before the merger, let's just make up, may have been $500,000. And that was, say, adequate under GAAP today to cover at least 1 year to 18 months worth of expected losses that will shake out. When you get the fair value work done, the third party who estimates fair value, they're looking at it as if you're an investor. So would any of us just buy that portfolio minus 1 year allowance reserve if we were putting up your own money? The chances are no, because you expect losses from that portfolio to shake out year 2, maybe year 3, maybe year 4. So you want to bargain for a price today when you're buying those loans that absorbs all the losses by the seller. So in my example, you might, have a $500,000 allowance count, and that's correct for accounting. But in terms of the acquisition or the merger, the third-party valuer, they're going to estimate that allowance count or a discount, credit discount, probably to be at least 2 to 2.5 times that. Because their thinking is under the kind of a CECL model, looking at expected cash flows for the life of the portfolio. So maybe you can connect the dots a little bit with this new current expected credit loss model, similar to acquisition fair value, if you've gone through that effort yet, and if you haven't, a lot of rules, a lot of moving parts within the merger account. So, okay, here's the formula. Keep that in mind just in general. The bottom bullet, allowance for loan losses, includes all expected losses over an asset's remaining life, allows loans to members, net of the allowance, to be presented on the balance sheet at the amount expected to be collected. When I went to college many years ago, we learned about that as net realizable value. So we expect that to convert to cash. Okay? So here's just comparison where we are today, incurred loss model versus expected. Incurred, probable, recognition threshold. You should not, provide for loans, losses that you have no reason to. So theoretically, you just approved a loan last month. It probably doesn't deserve any allowance count. You just underwrote the loan. You know the member's working. You know their credit score. They haven't missed a payment. So that kind of thinking is under an incurred loss model. However, under expected, that all goes away. You granted the loan last month, and you need to try to estimate what might the future losses be it year 1, 2, 3, 4, or 5, because that loan's going to still be around that long, right? Incurred loss, you're based on past events and current conditions. And really, past events, to put it, to something you're probably familiar with, historical loan loss ratios. You probably use a 1 or a 2 look-back period for different categories of loans. That's your past event. Current conditions is what the examiners have dubbed as Q&E, qualitative and environmental. So that full effort is really helping you to make a judgment about whether the first part, the historical loss data, is relevant. So, if you developed a loss ratio for 2 years and you had a 1% loss rate steady Eddie for 2 years, but now you have delinquency that's double what it was a year or 2 ago, probably suggesting you're going to have some bad times or higher charge-offs in the future. So you might, from a Q&E aspect, modify your 1% and bump it up. So that's under the old rule, still in place today. The expected, based on past events, same. Current conditions, same, but the real new add, and reasonable and supportable forecasts. So get your crystal ball, dust it off, because this is where you have to estimate these future losses beyond what you ever did before. And you have to be able to support it. So, you know, a bunch of smart people around the table, and you're going to go ahead and come up with your own estimate, but then you have to have a regulator or an auditor, you know, come in and kick the tires on it and question, you know, the validity of what you came up with. So, you know, you want to do the best you can to document to support your assumptions. And I think in the long run, as long as you can document what you were thinking and then maybe back test it down the road to see if that held up, you'll probably be on pretty safe ground to convince an auditor or an examiner that you know, you did your homework, you understood the rules, and you can only do so much in terms of estimating the future. You're not expected to you know, guess for the next 7 or 10 years what losses may look like if you can't really effectively do it. But can you do it for a year out, 2 years out, maybe 3 years out? The consensus would be, yeah, you can. Okay, finally, so incurred loss, it's all based on probable losses. And under expected, it's going to move to expected lifetime credit losses, even if that loan was granted today. Judgment is required on both sides of whether the incurred model or expected model is used. And as indicated on the bottom, CECL model changes the timing of loss recognition. Under CECL, you're going to recognize losses day one of granting a loan, whereas under the incurred model, it would be over time. Okay, next please. As I said earlier, this doesn't just relate to loan losses, it's credit losses. So we'll have, you could have purchased credit deteriorated assets that, again, most credit unions don't deal with. Debt securities, which most credit unions might have in your investment portfolio. And then troubled debt restructurings, which those have gone significantly down from 2008, 9, 10 period. So anyway, just the point of this, let you know that this Accounting Standards Update, or ASU, it covers more than just loans, but we're going to try to focus more on the loan side. Next slide. Purchase credit deteriorated assets. I'll go through this real quick. It's almost more of a terminology change than any real significant. Today, if you purchased credit deteriorated assets, you would have what we call a credit discount. Back to my example with the merger. In the future, under CECL, we're just going to call it allowance for credit loss. So that'll be a little different. Next slide. Available for sale debt securities. Its amortized cost would be the amount you paid for the investment, which would be the par amount plus or minus a premium or discount. You'll have under the CECL an allowance account that we currently don't have. Plus you'll have AOCI, accumulated other comprehensive income or loss. When all said and done, it's going to be at fair value. The real issue here is the creation of an allowance account. It's going to be replaced what we currently know as other than temporary impairment, or OTTI. So under the existing rules, if you have an investment, a debt security, and the corporates all dealt with this in a significant way years ago. So they have a bond, and they believe it's impaired other than temporarily. They're not going to get all their principal back. they have a devaluation. The accounting today is you devalue that investment directly. And that becomes your new cost basis. So you don't write it back up if good news presents itself. It's basically, that's your new low, and you go forward. Maybe you do more bad news, but it doesn't come back up. With this model, on a go-forward basis, when CECL kicks in, you might have an OTTI that you're going to create an allowance for, as opposed to a direct write-down that you did historically. And the good news here is if the cash flows improved down the road and it looked like you were going to recover more principal than you estimated at that time, you can write it back up. So, probably not going to impact most of the credit unions in the session today, but, just keep it in the back of your pocket. There's a lot of stuff that goes into CECL, and some special rules with regard to OTTI goes away, and you do have an allowance requirement. If an OTTI would have been there, it's now going to be allowance for credit loss. Okay? Here's just one example of available for sale debt security. This is as of 1/31/22, so CECL has already applied. So it had an amortized cost of $1 million. The valuation account was $50,000, meaning the market value was $1,050,000. So that excess $50,000 was residing in accumulated other comprehensive income on the balance sheet under the equity section. And the current rating was AAA. Well, a month later, February wasn't a very good month that year. Amortized cost $1 million. Now the market value was $740 because the current rating dropped to CAA. So because of that, the market value dumped to $740. So you have now an allowance for credit losses you create of $260. That $260 could be recovered, if good news later presented. But you think it's OTTI at that point, and you'd have to write that off through the income statement. So on the bottom, the OCI statement, you'd recover $50,000 out of it to get it back to zero, and you'd have to charge the income statement for $260. Notice the language: provision for credit losses, not provision for loan losses. So we'll have a new description on the income statement that's not dedicated for loans. It's going to be generic. Okay, thanks. We have TDRs, trouble debt restructuring. Why don't we skip this? CECL model. Okay, I've talked a little bit already. Collective basis, assets with similar risk characteristics. So similar to what we do now, we have to look at historic. So how do you do that? You want to identify these assets, in this case loans, that have similar risk characteristics. So you could, this is not you must, but this is you could decide to allocate your loans by credit score or risk ratings without regard to vehicle, new, used, etc. You could use vintage, which is the year the loan was originated. That was fairly popular during the crisis and after, because credit unions were starting to see less and less loan losses for loans approved in 2010 and 11 and 12. But the ones that they had issued in 7, 8, or 9, those are still problematic. So a lot of credit unions tried to isolate those so they could do something specific with allowance reserves for the real problem portfolio. But the newer loans, times were better, people were back working, so things like that, they had different methods to assign risk. You could do it on collateral types, which is what most credit unions go with now. The term, geographical location. So these are, again, are not, you must do these all. These are just ideas out there in terms of what you can come up with. You still will look at individual loans based on unique characteristics, those that do not share similar risk characteristics. For example, if your loan portfolio has any medallion loans, taxi medallion loans, separate kind of a risk from everything else. So you probably want to pull those aside and deal with those separately. If they're delinquent, collateral dependent means that the only way you're going to likely see a return of principal to cash is from selling the collateral. So really when you have a foreclosure in process or when you actually have that foreclosure, that's all collateral dependent at that point. The borrower is not making any more payments. You're looking at the value of the collateral. Expected credit losses shall be measured on either a collective or individual. So you can mix and match. You don't have to pick one approach and use it for all. You can use a different one for each. So the model, high level, you have historical events, current conditions. Right now we're same as where we are today. Reasonable and supportable forecasts. That's the big change. Historical events. You can look at the historical experience of similar assets, delinquency analysis, credit ratings, risk ratings. So these are a variety of choices. You don't have to, do all 5, but these are kind of options you might want to consider. And I'll tell you now, you can go overkill with this. If you overthink it, you can come up with more and more and more data that will probably land you in a similar, allowance estimate answer, if you take shortcuts. So I'm going to put this information out here just so you know some are considering this, and I think it's important that, we hopefully leave the session today that there are some reasonable methods, and probably one in particular that you'll like that is very similar to what we do now compared to some of the other options. So don't get glazed over with some of the other options you'll never ever want to consider. And the information you'd have to gather is enormous. So there's a lot of vendors out there now that have surfaced in the last several years that are selling allowance account software, and they'll help you, crunch your data to go ahead and, dissect it every way possible so that if some scenario happened 5 years from now, it happened, 9 years ago, you can go back to 9 years ago and see, oh, look what happened when we had this event. Unemployment went up, or we had a weather event like Houston. Oh, look at that, delinquency went up, and then charge-offs went up. So you can kind of look back and say, this is the likely future outcome. So you would use that to try to guess the future in your forecast. But anyway, this is just one, suggestion. I wouldn't use it myself, but just to put it out there. We could say, here's the FICO scores, and we've broken it out by all these various categories of FICO on the left. And then we had data to enable us to know that if the loan at the measurement date was less than 30 days delinquent, current or less than 30, our loss over the long run, if we track that performance, was 197. If the loan didn't get charged off at 30 days, but made it to the 30 to 60 bucket, and we tracked it, what kind of charge-offs happened from it? 2.13. And if it didn't go charge-off by 60 days, but landed in the 60 to 90 degree delinquency, we have 2.33. of that group goes bad. And then if it's over 90, about 5.5% ultimately goes bad. So this is just a completely different way of analyzing the risk based on historical data. So if you develop this, and again, you don't just whip this together in an hour, if you had this, you theoretically could use this on a go forward to estimate future losses based on current, less than 30, whether it's 30, 60, and so forth. So if your delinquency is changing over time, you'd be able to maybe monitor from this type of analysis what the loss estimate may be. If you like this, I mean, you may want to start to gather that information just as a secondary approach to estimating allowances. Doesn't mean it has to be the way you do it today. I mean, right now, a lot of credit unions under today's rules, they do one calculation of the allowance count. And they say, okay, based on our monthly calculation, we need 2,360,511. Okay, that's one estimate. It's not right. It's an estimate. Maybe it's reasonable if we go in and validate and kick the tires on the assumptions. But I've always encouraged our clients do 1, 2, or 3 methods, because that estimate you just came up with, that's on one set of assumptions. And maybe you used a 1-year historical look back as a significant driver of that. Maybe you want to do another version using a 2-year look back. And then maybe you want to do a third version doing something else with individually evaluated assets. Maybe you're just doing something percentage-wise, and maybe you want to do something a little deeper. So anyway, you would have, under current GAAP, it says, there is no one answer. And a range of loss estimates is helpful, and then management would be responsible to select the best estimate within the range. So if you did 2 or 3 versions today, you might say, on a low end, we need 2 million. On a high end, we need 2.6. And my middle of the road that I started with, 2.3, that feels about right. So we're going to go with that. So you do the other 1 or 2 methods kind of as a barometer to maybe help validate the ones you typically use. So same thing with CECL. You're not locked into one method. You can do a couple different versions and decide down the road, maybe this type of analysis makes more sense. Maybe you don't have all the info day one, but you continue to gather it, and maybe 3 years out, you migrate to something like this. All right. Okay, so that's historical, the first slide, and now you've got current conditions, similar to the current qualitative and environmental, or Q&E. So, what do you want to consider? You want to consider underwriting standards. Have they changed based on whatever the first component yielded as far as a starting point? Do we need to adjust any of that based on changes to underwriting, general economic environment, bankruptcy filings in our region, changes in delinquency, credit ratings, risk ratings, loan to values? These are just a variety of things that you may consider to help determine what adjustment, if any, and I stress if any, is necessary based on current situation. Back in the 2008, 9, 10, 11 timeframe, every examiner in the country expected credit unions to have a Q&E factor that went up. And what the problem was is that probably made a lot of sense because the look back wasn't as informative. But roll forward a couple of years, now your historical is chock full of high loss years where you did recognize all those losses that you didn't have 4 and 5 and 6 and 7 years earlier. So now your starting point is much more realistic than it was 2 years earlier. So do you still need a Q&E? Chances are you didn't. And it should have been neutral. Just call it a day after you did your loss rate under current conditions if you think that's looking like the future. But when things started getting better, and you saw the graph where those allowance accounts dropped down and down and down and down, well, that tells you pretty clearly, if you're looking at a loss rate of 1 year, 2 year, 3 year, you've got some numbers in that data that are based on bad times. And now delinquency's down, and you're able to claw back that allowance because you don't expect those level of losses go forward. So you should have really a negative Q&E. And we had a lot of clients where examiners said, oh, you can't have a negative Q&E. Well, their own literature says you could. So we kind of put our clients on the right part of their guidance that said it could be positive or negative. But anyway, same thing here with the current conditions part. You're not necessarily going to come up with an adjustment to the first part, right? And here's some overcomplicated table. I think the FASB put out as an example to just show you we do know our stuff if we really want to. So I'm not going to go over that, but it's just something you could, if you had this same table, and it just kind of breaks out your portfolio by credit grades and balances and what percentage, gives you a pretty good high-level analysis. If you had the same table from a year earlier, then it might be helpful because you can compare the data from a year ago to today and maybe make some sense that things are looking better or looking worse or about the same. That might help influence whether you adjust the historical data up or down or leave it neutral. But this table by itself doesn't do anything. You have to have a look-alike table from an earlier period. Next. Okay, now here's where you separate the adults from the children. We have reasonable and supportable forecasts. So, this is just help me think out loud here. How do you do that? There is no fixed way to do it. Maybe change in prepayment speeds, would that come into play? Change in collateral values, geographic location, disaggregated at the portfolio level, expected credit losses using a discounted cash flow, which probably have 5 clients out of 350 that know how to do that. Internally and externally developed forecasts, economic data. So, this again, a lot of guesswork. We're trying to predict the future. Historical, we're thinking that our actuals are going to be the data on the left. We think the peer group on the right, guesswork, based on whatever we liked on the menu above of considerations. Maybe one of those made sense for our membership and our loan portfolio, so we went ahead and try to develop some forecasts. So based on delinquency at 12/31/21 going to 175, and the peer group is 149, we might want to do something to measure that negative expectation of higher loan losses during the life of the portfolio. Like I say, accountants that do this for a living get glazed over when you start getting into this stuff, so let's move on. Or get another cup of coffee. Okay, preparing for implementation. Okay, we're in 2017. You may not have these in your handout. I added these last night, this morning. So if you don't have them, I'm sure we can get another copy to you. But this just a little bit of a calendar saying in 2016, you really should have formed an implementation committee. Anyone here at the table? I think they formed one here about a minute ago.
No, last year.
But you'd have an implementation committee. If you haven't already done so, maybe get that on your radar for 2017. But during 17, 18, and 19, so we have some time, you need to collect data. And again, depending upon which method you go with, you may need a lot of data that you never really thought about. You know, one tidbit of data is if your credit union did a merger, you know, you need to have data from that merged credit union maybe, 2 years, 3 years, 4 years, 5 years back, if it's significant, so balance significant, and before you jump in and just do it. So collect the data for the next couple of years, develop appropriate model, and you may, experiment with some of the ones that are available and decide which one makes sense. By 2020, the year prior to implementation, you want to test the model, run parallel to the incurred loss model. Here's what we do today, here's what it looks like tomorrow. Then make any necessary adjustments that you might have to do. And then 2021 is when it goes live. For most credit unions, we're talking January 1, 2021. So the 12/31/2020 loan portfolio will be subject to CECL measurement that gets recorded in January 21. Okay? All right, next slide. So the implementation committee, in order to assure a smooth transition, implementation committee should be formed, should consider people from credit side of the credit union, finance, accounting, technology, and risk. So effective CECL model is going to rely on cross-departmental communication. You should, schedule some meetings with some outside resources. Could be your external auditors, could be folks from the league, could be industry experts, could be regulators, maybe not, other credit unions and financial institutions. So collaboration, I think, goes a long way when you're dealing with something as onerous as CECL. Next slide. Data needs will be dependent on the model selected and key risk characteristics of the portfolio. So depending on what you do, you might need credit rating scores, the balances, loan terms, interest rates, loan to values, date of origination if you go vintage, product collateral type, geographic location. So you can get as granular as you want. Does a red car have a higher risk than a blue car? That would be crazy to do that, but I mean, you can overthink this. That red car, blue car, I did have an examiner at a California client one time try to argue something along those lines because they were going to put more money in the allowance.
Right, orange car, maybe, yeah. Orange car, get more.
All right, no examiners in the room, right? Preparing for implementation, some data considerations. First of all, know where it is. How do you access it? Do you have it on backups? If you had, information you wanted to grab from 10 years ago, if you did 5 mergers between 10 years ago and now, can you access their data? What's the quality of it? Is it similar by say, credit union? How do you store it so it's available when you do need it? access and so forth. Next. Preparing for implementation. How far back historical should you go? Anybody have any thoughts?
10 years?
10 years? And why 10 years?
That's a nice round number.
Nice round. So is 2.
Yeah.
Okay, the ASU, the Accounting Standards Update, does not require a specific look-back period. So again, this is very, very, very subjective, and it's whose responsibility to estimate the allowance? It's management. Okay, it's not the auditor, not the regulator, although we have a stake in it. So management is responsible. The more you can support in good conscience how you arrive at your look-back period, at your decision to adjust based on current events or not, the better, position you'll hold because, you've considered it and you're hopefully able to express that to outsiders questioning, why. So it's always good to back test. Even with today's rules for allowances, you make assumptions. If you use a 1-year look back or a 3-year or a 5-year, that's all well and good. Maybe you can argue why that makes sense. But you go 2 years down the road and then look back to see what actually happened. How did our estimate of losses for troubled debt restructures, how did that actually pan out? Did we blow through that allowance account 6 months after we set it up? Or is it still adequate? Doing some back testing is always a good way to help prove or disprove your assumptions were reasonable. And then, of course, if they're not, you should adjust as you go forward. So an entity may use historical periods that represent management's expectations for future credit losses. Entity also may elect to use other historical loss periods adjusted for current conditions, other reasonable and supportable forecasts. So you could use a 2-year look back for credit card portfolio, maybe 5-year for mortgages, maybe 3 years for something else. So you're not locked in with, one assumption fits all. The expectation is whatever makes most sense for that credit risk, for that asset, in this case loans, you're going to parcel it out to do the best job you can to estimate future losses. As a rule of thumb, look-back time period should be at least equal to the average remaining life of the portfolio segment. So what that says in English, let's say we're talking a car portfolio. Most car portfolios, even if they're 7-year car loans, they're going to probably cycle through every 3 years. So 3 years the shelf life of a car loan. So you probably want to look at least 3 years of car loss data, maybe 4, 5. But there's no need to go back 7, 8, 10. You get diminishing returns because the further back you go, you have to then evaluate, well, was there some aberration about some charge-offs in that given year? Did we do indirect lending? Did we have a crazy indirect lending relationship that charge-off spiked for 2 years because we had a bad loan officer? Stuff like that. You have to then try to whittle out of your numbers. So if you go within a reasonable, 3 to 5, you can probably have some memory of, if there were any kind of unique circumstances. For example, I had a client a couple of years ago. They had a new collection group, and what the new people that came in did, they went back and looked at all the charge-offs for the past, make it up 5, 6 years, and they found that the credit union never ever filed for insurance claims where they could have on some of the existing insurance they had. Collateral protection, they could have gotten a rebate on some of that, and other types of insurance. So they went ahead and worked that to death. They had a recovery, I think it was about $400-something thousand in 1 month. So not going to happen again. It was great news that they got that, but in terms of measuring your allowance account and historic data, you don't want to use that one-time event. That's good news in this case, because it's not going to happen. It's not realistic to think it's going to happen again. So same thing with the losses. If you had a one-off type of charge-off, call it out of your data and explain why. So the auditor, examiner identifies that one or two loans that you left off the list, have a good answer as to why you did. Transition rules and guidance. So we're about at the halfway mark in the slides too, so I think the remaining slides will go a little faster. Some of them I'm going to probably jump right over, and you'll appreciate that. So why don't we start with slide 26 with the new deck. Those things I just covered were not in your original handout, but maybe the guys this morning got the new one. So transition rules and guidance. When did all this come into play? As I mentioned earlier, we're all non-public companies, which means credit unions. Public companies are those that trade on the security SEC. Public companies, they have to adopt this a year earlier. So credit unions get to take this to 2021. Really, the measurement period will be December 31, 2020. That loan portfolio, you'll come up with your CECL allowance estimate, and then you'll record that January 2021. Second bullet, you do have the option, hold back the laughing, you have the option to adopt this early.
Oh, yay.
So, that's always good to have in your bag of tricks. The amendments will be applied through cumulative effect adjustment to retained earnings at the beginning of the first reporting period in which the guidance is effective. And what that means is, let's say under old GAAP, the incurred loss model, your allowance account says you need to have $2 million in it. And that's exactly what your financial statement reflects. On the CECL method, it now says you need $3.6 million. The lady here almost choked on her tongue. So now you have to increase your allowance by $1.6 million. How do you do that? We know we need to credit the allowance account. That's the easy part. What do you debit? Okay, you would normally debit provision for loan losses, or now provision for credit losses, but not in this case. Back to the history lesson I gave an hour ago, day one, when credit unions adopted allowance account, they got to take it out of equity directly. Same thing holds true here. That's what a cumulative effect adjustment means. You'll debit undivided earnings directly, which is bad news to your capital, but avoids killing your income statement. All right? So you get one shot at that. All right, next slide. This I'll just tell you for the sake of telling you, but there's prospective, means on a go-forward basis. Transition approach is required for debt securities. So if you had available for sale investments that were debt securities, if you had other than temporary impairment on December 31, 20 that you had already recognized, you're not going to uncook the egg. That stays there the way it is. So you've lowered the cost basis of your investment. But on a go-forward basis, if there was further deterioration or you thought you weren't going to collect all the principal from your investment, at that point you'd jump into the allowance for credit loss accounting that we covered on one of the earlier slides, and then you would have the opportunity to recoup that if information improved as you move forward. And pretty much same thing with purchase credit assets. You're going to have the opportunity to write those up. You would go with an allowance count on a go-forward basis. I doubt you're ever going to see that. Okay, next. So the impact on the allowance and regulatory capital. Losses would be recognized sooner than under the incurred loss model. Again, it's front-loaded. So you made $10 million in loans last month. You're happy about that and the interest income you're going to generate over the next couple of years from it. Bad news is you're recognizing the losses on that same $10 million day one. So ALL balances will generally be higher. I can't really imagine where they'd be lower. So it says generally. You probably want to mark out generally. Impact will be influenced on how regulators, investors, and auditors interpret CECL model. So again, I've stressed a few times, own your model management and be able to support why you made the assumptions you did. Talk it over with your auditor, maybe the regulator, colleagues, before you implement it, so you feel like you're on pretty safe ground. But what I have a fear for is that, and I'm going to say from the regulator side, you may have a regulator come into a large credit union that has a CPA, staff of accounting and finance people, and they've come up with the most complex method you can think of, and it overwhelms you when you try to understand it. But it landed with a number that maybe was 2.5 times what the allowance was before. So you might run into some bias by regulators or auditors that say, oh, 2.5 times the base amount is the right answer because XYZ credit union down the road that has super smart people, that's what they came up with. So my expectation coming in is yours is going to be 2.5 times what it was the day before, and maybe you're using a different method. Maybe you didn't have the wherewithal to estimate 5 years of future losses, and the first group did. So, hopefully it doesn't get thrown into one basket that they should all be 2x or 2.5x of what the starting point was. So hopefully, your auditors will, hopefully help you fend that off, because there is no one right approach or one right answer. So, next. This is an NCUA statement that came out related to CECL. And I want to read it because it makes no sense really to me. A little bit does. It does, but then it kind of falls off the rails. So it says, while NCUA's risk-based capital rule, which takes effect January 2019, and covers credit unions with assets of $100 million or more, it allows 100% of a credit union's allowance for loan losses to be included in the numerator of the risk-based capital ratio, which is positive. Okay, I'm with you there. Having to increase the allowance if necessary as a result of the new accounting standards may be increasingly problematic for some as we near implementation of FASB's new accounting standards. So the only thing I can make sense of it is this rule takes effect for the capital January 19, so it's a couple of years before CECL. So your allowance count, kind of as is going to be added to your capital ratio, and then when you do adopt CECL, you're taking it out of undivided earnings. So say that went down $1 million, but your allowance went up $1 million. So it's a push. You're in the same mathematical situation. I don't see how it's worse or problematic. Next table helps explain it. So when the risk-based capital rules kick in 19, you have two things to comply with. The net worth ratio, which is what we're currently familiar with, 7% or greater, well-capitalized, 6 or greater, adequate, and so forth. But you have to be able to meet both sides of this. And you have to have 10% or greater under the new risk-based capital rules, in addition to 7. So what's really going to get hurt as a result of CECL is the column on the left, net worth ratio, because we're pulling $1 million out of it. And the net worth ratio, as you all know, doesn't include the allowance. So that's what's going to get hit in terms of impact of CECL. You know, the good news is most credit unions have, 11% capital. So even if it took a whole percentage point, or more out of your capital ratio, you're still well above well capitalized. But those that are, on the brink of 7% or 6%, they have to really start budgeting to look what the future may look like, because overnight they could be in prompt corrective action, whereas they were on safe, grounding the month before. Okay, so that's just a table of what the new rules. Some sample methodology calculations. So the FASB guidance, in this ASU you can, the 100-page plus of it. Much of it is example-based and table-based, some of the things we've got in this presentation. The real FASB part is probably, less than 20 pages as far as impact. But it talks about potential estimation methodologies. The first one is expected loss rate, and I would expect you guys to probably change this to expected love rate. You'll like this method because it's kind of similar to what we do now. It's understandable, so we'll spend most of our time on it. But lifetime historical loss rates applied to financial assets, similar key risk characteristics. Historical loss info can be internal, external, or both. Institution needs to select a reasonable period to base its historical loss rate information. And as we said earlier, usually at least as far back in the look back as you think the portfolio is going to last on a go forward. So car portfolio, think you got a 3-year future cash flow. On that car portfolio at month end, you want to look back at least 3 years to kind of match what you're trying to predict the future cash flow is going to be. A reasonable period should be considered having similar underwriting standards and contractual terms in comparison with current. So the example I said earlier, if you're looking back and you had a year or two of crazy losses from indirect or some other reason, and it's not going to happen again, or you hope at least it's not going to happen again, you don't want to measure that up. It's not going to be helpful. Okay, then we have a vintage analysis. And again, you may be familiar back from 2008, 9, 10, where regulators may have suggested credit unions, do some analysis to break out the portfolio on loans originated, especially real estate, in 2006, 7, and maybe 8, because those are the highly overpriced real estate markets, and they had you running all kinds of reports of current fair value to the loan balances, and if you're in a quadrant of negative equity, do something special with it. So vintage refers to the date of origination. Vintage analysis similar to the expected loss rate approach, except it further segments the portfolio by date of origination. Segmenting by origination will reveal the timing of historical loss experience. So as we show an example, that's kind of cool. You know, you might like the vintage. You're not going to like probably the degree of data that you got to gather to populate the tables to help make that make sense of it. Okay, next couple. You have a probability of default and loss given default modeling. Well, it sounds complicated just from saying it, but it's statistical-based calculation, uses various loan risk parameters. And again, this would be by the type of loan. So you take the probability of default, and that's going to be the probability that the loan in a segment will default. Similar to what I showed on that one chart with delinquency, 30 and less, and you know, it basically tracks, you know, what percentage is going to historically go bad if it gets to 2 to 6, if it gets to 6 to 12, and so forth. But that was just based on credit score. Okay, you could then complicate that table by saying what was the year that those loans. So we'll take our 700 and above credit scores, but now I'm going to drill down and say, were those granted in 2000, 20, 19, 18, 17, 16, you know, at the time. So you get that info. The loss given default measures expected loss net of recoveries on those that fall into the charge-off category. And then the exposure is current balance at default. Expected loss is the math of the above. So as an example, let's say that auto loans, that you know that when you repossess a car and sell it, on average, and you could do this calculation, you know, pretty easily, that you're going to lose 40 to 50% of the loan balance as a deficiency charge-off. So you can prove that, you know, over and over and over. Let's just say 50%. So, okay, we know once a loan gets to repo, we're looking at a 50% loss of that balance on that day. The big question is, how many loans in our, you know, $300 million car portfolio are going to get to repo? So you could do some data, you know, analysis to help answer that. And let's say it was, make it up 1%. So you'd have, here's my total portfolio, 1% is going to go to repo, and that dollar amount I'm going to lose 50% on, and basically that's my allowance for car loans. And you do the same for, you know, home equity, you do the same for other types, you know, unsecured. So, you know, it helps you really understand your portfolio, maybe one benefit, but maybe a method that's way complicated benefits that you get from it, or it could be a secondary type of account that you do down the road, just to kind of kick the tires on your first calc. So, discounted cash flow, why don't we jump over that? Calculates future cash inflow, too complicated. Migration, similar. Tracks performance of financial assets over time based on risk. Type of analysis uses loan level attributes to track the movement of loans through various loan classes in order to estimate the percentage of losses likely to be incurred in the current portfolio. This again, back to the table I showed you earlier. That's more of a migration analysis. So significant amount of data required, so kind of a turn off right there. Effective risk rating method is a must. So you really have to have good metrics to be able to consider that. Credit union should select appropriate model based on its specific portfolio. So those are the kind of top 5 that are out there as suggestions. Next, please. Loss rate approach. Okay, simplest method. I hear the cheering in the background. Portfolio is divided into segments. selected based on similar risk characteristics, very similar to what we do today. Could be by loan type. Most probably use that. Could be loan to value. Could be collateral type. Could be size of the loan. Could be credit scores, geography, loan term. So these are some of the things. And you might use 2 of the things for real estate or commercial loans that you don't use for consumer loans. So you can mix and match whatever makes most sense for that type of loan. Determine historical look-back period by segment. Okay, we're all pretty comfortable with that at this point. Reminder, FASB does not require a specific look-back period. However, look-back should represent management's expectations of future credit losses. Next, please. So you're going to calculate lifetime credit loss rate. That's different. We have credit loss rate for lifetime. How do we do it presently? It would be incurred loss. So we'd only measure up the losses we think we have in the portfolio today, not what we think may shake out year 2, 3, or 4. So consider current conditions and reasonable supportable forecasts. That's just a basic CECL method. You might want to consider change in unemployment, prepayment, change in collateral values. These things may help you decide if you have a current condition adjustment that you want to use to modify the lifetime credit loss rate that you do first. Okay, next. All right, so here's an example. XYZ Credit Union has decided to use the loss rate approach to calculate its expected credit loss. Loan portfolio, 7-year amortizing loans, all with similar risk characteristics. Amortized cost, $100 million. Historical lifetime credit loss, 2%, using 7 years of loss history. So we know out of the gate, this has got to be a real estate loan. So the 7 years, that's what we think the duration of that portfolio is go forward. And you can calculate that by doing some study of what's your turnover rate for a given loan type. So let's say 7 years is what we proved and management proved. So now, we want to have 7 years of loss data because that's what we need to cover on a go-forward basis. So we're going to look back and say, well, last year we had no losses, so there's a 0. The year prior we had 0.2%. The third year we had 0.5%, and tally up 7 years worth. Try to make a judgment if there's any aberration in that 7-year run, or is that about the norm? More importantly, is that what we think is realistic on a go-forward basis? And if we say yes, we think all that's reasonable, add the math for 7 years, and we came up with 2%. So this 2% is not a 1-year loss rate. It's an accumulation, in this example, of 7 years, because we're predicting a 7-year go-forward life to that portfolio. Okay? Some of the losses will shake out 1 year after CECL, 2 years after CECL, so on and so forth. So then we go to adjustments. Do we have to make an adjustment? We don't have to make an adjustment. We have to consider making an adjustment. So we analyze the current conditions. Underwriting has been consistent. Unemployment rate increased in our industry. Real estate values have decreased. So those are facts that we know at the measurement date. So how do we react to that? Sounds like we've got a couple, 2 bad news things, 1 neutral. So because of the unemployment increase, we're going to throw 6 more basis points on top of our 2% historical. Seems reasonable. How do you get to that 0.6? You know, have support. Be able to talk a good game on that, just in terms of, yeah, seems reasonable. You know, wouldn't make sense to double it from 2% to 3%, you know, adding a whole 1%. Decrease in real estate values, that's probably more important because if the values of real estate go down, and that's how you're ultimately going to recover the loan from a foreclosure, selling collateral, that, you know, we're waiting at 14 basis points. So when all said and done, our expected loss rate for the future is 220. But again, a single year may have been, you know, 1/7 of that, very small. So now we're going to apply the 2.20 to the amortized cost basis of that segment, 100 million, and our allowance for that particular loan type will be 2.2 million. Okay, so let's say next month we had 10 million of repayments. So we have 90 million, and we didn't grant any new this type of loan. So you'd have 90 million at 2.2. So you'd have a reduction. The 2.2 would be less. You're going to recuperate that in your provision for credit losses. On the other hand, if the portfolio went from 100 to 110, you're going to put 2.2% of that 10 million that you just granted 30 days ago, not concerned about any risk because you just visited with the borrower and underwrote that loan, checked collateral values, etc. Nonetheless, you have to front load the allowance, and you're going to recognize the 220% and, you know, have that cushion in the allowance day one for the future.
But we do that now when we're using the historical loss ratio to that.
Yeah, the comment is, well, we kind of already do that now, and you're right, except now you're doing a multiple of 7 versus what you're currently doing a multiple of 1 likely. Anybody in the audience have any questions on that one? This is the one you're going to probably want to adopt. And just to say it, you know, I'll be available. You know, Tracy and Denise will be available if you have any questions on this down the road after you mull it over or get to your implementation stage. We can circle back and help answer any questions. This I'm going to jump kind of over the loss rate approach. You could further complicate it, even though this is the simplest, with correlation and sensitivity analysis. I only have it on here because it's in the ASU materials, but it kind of talks about a single, you know, change of, could be, say, the unemployment, could have a significant impact on your charge-off data. And they suggest that if it's an 80% correlation result, you probably want to deal with it. The next slide just shows an example, but a lot of moving parts. So I'll save that for private calls. Anybody really wants to discuss that, and you're buying the beauty.
Sorry to interrupt, but you know, getting back to your that model you were showing on the first slide, you know, the adjustments. So I guess there's a lot of subjectivity there. So what would you recommend, like changing it quarterly, semi-annually, annually? And then I know with depending on what part of the country you're in, like the unemployment and the real estate factors are going to change as well.
Right. The question comment is, that with regard to the adjustments based on current conditions, in the example, we threw some extra basis points for increase in unemployment and a decrease in the collateral value of real estate. And the question is, how often should you go through that consideration, and what maybe can you base it on, or should you base it on? You're in the same spot, I would say, as you are today with Q&E. And over the years, especially 2008, 9, 10, 11, when the expectation, especially by regulators, was that every portfolio type should have a Q&E adjustment, even when charge-offs and delinquency were declining. If you looked at any depth of how did the credit union come up with that, it's just like throwing darts. And there was no real foundation because they didn't have the metrics to say, well, when unemployment goes up in our area, and let's just say Hawaii, that 2 years or 3 years later shakes out in higher losses. And because of the increase, we're going to respond now to the future expectation. It's very, very hard. I've always, over my 30 plus years of doing this, I've tried to dumb it down, anything GAAP accounting related, to the least common denominator, to comply with the rules, but in an understandable way or without getting overly complicated. Maybe comply with 85, 95% of it. Forget about that 5 or 10% that's not really relevant. But I would put it this way. All those Q&E things you could identify, unemployment, new housing starts, et cetera, maybe visitors to Hawaii, all that, it all shakes out in delinquency. To me, that's the common denominator. No matter what the problem was. I lost my job, I got divorced, had medical issues, et cetera, it shows up in delinquency. So I don't really want to try to guess and quantify, all the multitude of reasons a loan could go charge up, because there's 100 stories. So delinquency is the one standard that people don't pay, and that's usually the beginning of the end when you're going to have a charge-up. So I would recommend really focus on your delinquency changes, and don't get fooled by the percentage. Keep your eye on the dollars, because you see now credit unions that have been going all out on indirect car loans in the last 5 years. I just left a credit union client in California, and their indirect has grown 50 to 80% every year for the last 5, 6 years. Thankfully, they do it very well, but their delinquency ratio is always equal or better because they're growing the portfolio so fast that the delinquency, is understated to some degree. The dollars may have gone up, because of the growth of the portfolio and some problem loans, but it gets buried in the overall big number. So focus on the dollars and the percentages, but don't just, hang on to one of them. And try to make some judgments based on that as to whether you're going to historically see higher losses. We were doing a real dumb, caveman math approach back in the problem days when if a credit union had delinquency in a more level time, make up, say the 60-day plus, and it was $1 million. The next year come back and delinquency was $1.8 million. We had worked up that the incremental part of $800,000, depending on the type, whether it was consumer or real estate. If it was consumer, maybe the charge-offs on that new bucket of growth would be 33%. And maybe on the real estate, it would be 20%. So we kind of had some high-level estimates in our pocket to try to say, this is what I would expect. The credit union came to a similar answer with a lot more attention than what I just said. And, it often reflected that they were on top of it, or in some cases, no matter what delinquency grew, doubled or more, they didn't react to it. They just hung on to a 1 or 2 year look back, and they didn't address Q&E. So, long answer to your question, but I think I would hone in on delinquency, and based on it, decide if I'm going to adjust my historical or not.
And then just document it, right?
Just document.
Yeah. Because the examiners will never give you a recommendation. They'll just hammer you on how do you justify your methodology, right?
Well, I'll tell you, I've seen some fancy analysis taking into consideration 9 or 10 Q&E factors, and they're all nonsense because they seem reasonable when you read them, but when you start to discuss them with the CFO or whoever created it, they'll be the first to tell you honestly that they're kind of throwing darts. That seem reasonable. Got it from a neighbor credit union that is only share. Examiners, thought it was good. So.
Okay, thank you.
So loss rate, the advantages. Probably should have put the first one in, big font. Simple to understand and implement. Similar to current allowance approaches used by most credit unions, and easily adjusted. This advantage may show historically irrelevant data points, and what this goes back to is, that example I gave where you might have a $400,000 recovery in 1 month. So that's part of your data, be on the lookout to exclude things that are kind of one-offs that are not likely to happen on a go-forward basis. If you had, terrible charge-offs in a given year due to a loan product you don't offer anymore, or a loan officer that, you filed a bond claim on for inappropriate indirect lending activities, you may want to be sure you consider that. Might not meet auditor or regulator expectations, so maybe too simple. Hopefully, that doesn't come up, but again, I'd stand prepared to defend your method. It's in the literature. If you choose loss rate approach, and your auditors should be able to totally back you on that, as long as you're doing it in a reasonable way. All right, excellent. The vintage analysis. Similar to the loss rate in terms of creating loan segments based on common characteristics. However, it's further segmented based on the year of origination. So you analyze the lifetime loss experience evaluated by year of origination. You may not have that information. You probably don't at the ready. You could get it, but again, how much, data gathering do you want to do? Loss rates are calculated based on net charge-offs divided by the original loan balance. Okay? Vintage goal is to gain information on how losses are occurring to better discern the trends, easier identification of loss anomalies. In fact, again, loans, real estate, granted in 2005, 6, maybe 7, those are the ones that were overpriced, overlent, and values came crashing, especially in the Sand States. So, when you had a loan that was granted in 2009, 10, 11, that was good news because it wasn't with the stench of 2007, 6, or 5. Loss rates are more granular, lend themselves easily to regression analysis, identify relationships between loan underwriting and economic variables. So you can probably learn more about your portfolio with minutes. Here's an example. not going to beat this up too much, but XYZ Credit Union has decided to use vintage loan portfolio, 4-year amortizing loans, all similar risk. They track loans on the basis of the calendar year. Conditions are expected to worsen over the next 2 years, but cannot be reasonably forecast beyond that. And so here's loans that were granted in 2000 X1. We tracked the loss history of those originations. And year one, there was 50,000 of loans that charged off, 120, 140, and then 30. Kind of what you would expect, right? First year you grant the loan, most people are not going to charge off the first year that you make a loan. You'll have a handful because some, whatever, lose a job, medical, marital, you name it. And so you have some that fall off within 12 months. But the majority happen in year 2 and more so in year 3. And then back to year 4. By year 4, they're all pretty seasoned. So even if the underwriting wasn't so hot and the credit scores were not so great, you could probably see that a lot of people, they've hung in there for 3 years and they're going to find a way to pay, even if they're delinquent. Now and again, they're not going to go charge up. So the first year and the 4th year, pretty modest. 2 and 3 are the bigger. So we track that, based on historical, and you can see year 2, similar trend. 50 to 120 is an 80 increase the first year. Second year, 40 to 120. That's 80. I'm sorry, the first one is 70. Year 3, we got 70. So you have some similarities with the increase from year 1 to year 2. Year 2 to year 3, on average, it's about a 20 to 30 dollar increase, and then it comes back down in year 4. So you can make some assumptions about maybe year 4 will be a certain percentage of year 1. So you have year 1 under your belt, and maybe you can track this stuff and say, well, we'll on average lose 75% in year 4 of what we lost in year 1, or some other relationship with year 3. So you basically populate the table with information behind you, and then you make your assumptions. So for 2006, year 4, we're estimating we'll have 60,000 of losses. Then for those originated in 7, those 2 categories, 190 and 70, and basically you're kind of predicting the future 4 years worth based on past history by vintage year of origination. All right. So in this case, $1,260,000 would be that final answer, and that'll be that. Okay. Next. Vintage Advantage captures the life of the loan losses for more accurate analysis, assuming the assumptions in are good. Method is useful as a forecasting tool, useful in establishing relationships to environmental factors. Significant data required. Downside, only as good as historical data that you have. Increases complexity. So this is probably choice 2, beyond the first one, that I've heard clients talk about. So we'll see. Discounted cash flow. When can I use discounted cash flow? When you have somebody on staff that really understands it, and can CEO and everybody else. I think we have a volunteer here in Honolulu. An entity may estimate expected credit losses for some financial assets on a collective pool basis, may estimate expected credit losses for other on an individual. As a result, methods used to estimate expected losses for an asset may change over time. Again, you don't have to lock into one method for all product types. Pool of homogeneous loans may initially use a loss rate method, but the expected credit losses for certain individual loans may later be measured using discounted cash flow. I don't know how common troubled debt restructures were in Hawaii during that 2007-09 timeline, but the proper accounting for TDRs for the allowance was a discounted cash flow. So some credit unions got a little bit familiar with discounted cash flows by doing the ALL calculation for them, but quite honest, most probably just jumped to the collateral dependent approach and said, well, here's the loan balance, here's the fair value, cover the difference, or a percentage of the difference, which, just to say it, is not GAAP. Okay. DCF, more discounted cash flows in one loan program. Why don't we move on to something more? Here's another calculation. A lot of moving parts. So those of you who need some sleeping material, go back to slide 52 tonight. That'll do it. Some advantages: provides both market value, fair value information. Simple level 2 and 3 inputs. You got to even know what a level 1, 2, and 3 input is. That has to do with fair value approaches. See that with things at market value, like investments available for sale. Things that get measured at fair value for balance sheet. So you have either level 1, where you can go identify the identical asset, maybe often in the stock market, and price it. Level 2 is usually a similar asset that's priced from a pricing exchange. 3 would be something like a foreclosed asset. There is no real independent third market. It's very subjective, and so you have to have a lot more opinion and assumptions into a level 3. So analyze large volumes of loans, I guess theoretically, easily, based on a tier system. So I don't see anyone using discounted cash flow. So overview of approaches. We have the 4 most popular here. Loss rate approach, simple to create and understand, similar to current ALL approach. Again, they show historically irrelevant data points, stuff we already covered. Vintage analysis, so this is just one table to kind of jump you to previous slides we already covered. Next, please. Right approach. Proposed standard requires credit unions to use methods that estimate and reflect past events, current conditions, and reasonable, supportable forecasts about the future. Remember the triangle, I think, earlier on? So your credit union can choose from a variety of methods, including the loss rate, roll rate, probability of default. When determining which method is right, some key considerations would be balancing the results needed with the time and effort required, gathering applicable data, ability to apply the method consistently over time, support for any forward-looking data, views and subjectivity, governance, controls, et cetera, et cetera. One thing I want to go back to there is ability to apply the method consistently over time. Can't say enough about that. And if your assumptions are say pretty aggressive, that you think you can predict the future for say 4 years out, and we have the same portfolio, but I think I can do it, in good conscience for 2 years out. Okay, we both have a GAAP compliant allowance count. I'll support mine till the cows come home, and so will you with the 4 year. So once you get started, remember day one, you're pulling dollars out of undivided earnings, setting them up into the ALL. That's what hurts. Thereafter, if you stick with the same methodology, yours being very aggressive, mine being very conservative, or less conservative, I guess. We're going to have the same provision expense month by month by month because we have the same portfolio. So our dollars of growth are pretty much going to, if that portfolio stays relatively similar, we're going to have a similar provision once you get started. One example maybe you can connect to. I had a client years ago that the CEO was an ex-banker, and the banking allowance account, going back in time, was pretty easy, kind of like the old examiner model, 25, 50, 75. They did 1% of the portfolio. So whatever the balance of loans was, regardless of aging and delinquency, 1%. Easy to do, very objective, and that provision, as long as they did it the same way, was always a realistic provision. We came in to do their audit the very first year, said, what is this? Your delinquency is like 0.2. You have no delinquency. And your charge-offs are like 0.25. You have no charge-offs. So the allowance, in our view, should have been overall, making it up, say 0.4. And they had 1. So they had a double allowance. So we recommended they claw that total dollar of the allowance back to a more reasonable GAAP number. But the minute they did that, on a go-forward basis, if they stayed consistent with the new method that we had introduced, their provision is exactly the same as it would have been had they stayed with the 1% for the next 20 years. So once you do the ALL consistent, the PLL is going to just tag along with it. So, okay, next slide, please. Okay, winding down on this perfect time. Key takeaways, do's and don'ts. Do start planning today. I think there were a couple of ad hoc committees started 2 hours ago. Form an implementation committee. Discuss your data considerations. Consult with your accounting professionals. Consider future capital impact, especially if you're on a bubble of 7%, 6%. Evaluate your budget. Educate your board. Don't wait. Implement the model well before the effective date, so you're having a pretty good idea what it's going to cost and what the impact will be. Current accounting is still effective. You cannot increase the allowance today before CECL applies, trying to get ready. And I would argue, why would you want to? Because then you're punishing your income statement. But we've had clients that have always had a very, very conservative balance in their allowance. And the honest answer, they'll tell you, yeah, we're trying to get ready for CECL. Okay if we have some extra in there. So it won't be as big a jump from them to get from that point to where they need to go. But, can't be ridiculous.
Just pad your Q&E.
Sorry?
Just pad your Q&E.
Yeah. So, anyway.
Wait, my auditors are in here.
Three Hail Marys, you'll be okay. So, so don't implement it early unless you choose to do it December 18th, which I don't think anybody will. And a couple minutes for questions, and as I said earlier, you can always reach out to our friends at Credit Union Pacific, and they'll either help you or I'll help get in touch with you as well.
No question? Okay, I'd like to thank Douglas, Tracy, and Denise for this opportunity to discuss this important topic. In closing, on behalf of the Hawaii Credit Union League and CU Pacific Audit Solutions, thanks very much for joining us today. Thank you.
Thank you.
Thank you.
On the spot.